Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Mark Ackler and Mert Ishiri join us today from Chicago. Mark is the managing director, and Mert is EIR at Math Venture Partners. Prior to Math, Mark was an SVP at Redbox, a founding partner at Kettle Partners, and co-founded 4 companies. Before joining Math, Mert was a serial entrepreneur and most recently co-founded SwipeSense, a healthcare technology platform that eliminates medical errors, and was acquired by SC Johnson in 2020. Together, they co-authored Exit Right, How to Sell Your Startup, Maximize Your Return, and Build Your Legacy, a book written to guide founders every step of the way, from negotiation through to a successful exit. Today, we will talk about the book and the recent news about their firm, Math Venture Partners, that revealed they do not intend to proceed with raising a Fund 3. More context on that in a bit here. With that, Mark and Mert, welcome to the show.
Great to be here.
Yeah, Nick, this is great. You know, long-time fan, first-time caller. We're really excited. We're really excited for this conversation.
It's so funny how many times we've crossed paths over the years, and this is the first time on the show. I do remember that your partner, Troy Henikoff, who's kind of a mainstay of Chicago tech, he was, I think, in the first 10 episodes. So this is like 8 years ago. So coming full circle, guys.
Oh, this is great. Yeah, so we've got a lot to talk about, a lot going on.
Okay, so let's start out with quick backgrounds, give the audience some context here. Maybe we'll start with Mert. Can you give us kind of the 2-minute background and path to venture?
Absolutely. Born and raised in Istanbul, Turkey. And I'm sure just like many of our listeners, you know, I had the candy racket in elementary school. Like I was always working on some startup somewhere. In high school, I sold t-shirts. In college, I sold insurance. And after I graduated, it was very obvious what I wanted to do. I wanted to be a founder. I helped start a company with my 2 roommates called SwipeSense, a Chicago-based healthcare technology company aiming to reduce hospital-acquired infections, which then grew to the safety platform for hospitals. We got to a successful exit. It was a long road. I'm excited to share more stories of like the lessons learned along the way. But joined SC Johnson, absolutely hated the large company life. I just didn't realize, this is why I started a company.
You're not mincing words.
I did stay for about 1.5 years. Look, I view the exit as sort of like a B2B sale. You want to make sure that the customer is happy. So wanted to make sure the integration was done right. I left and joined Mark on this wonderful adventure at Math Venture Partners. Really, our relationship goes way back. You know, he was one of those Yoda figures for me when I was trying to figure out how to play with a lightsaber. He was the one who showed me of like, all right, this is how you do this. He was the ally that I truly had on my corner along the way, and I'm eternally grateful for that. And we try to project that forward with Exit Right. But that's sort of my story. I've always been a fan of entrepreneurship. Always been a fan of founders, and lo and behold, and that's the world I want to be for the rest of my life.
Well, and Mark has been the sage mentor for many in Chicago.
Truly.
People here certainly know him. I'm sure they know him across the country as well. But Mark, can you give us kind of your quick background and path to VC?
Sure, but you know, be careful when you ask an old guy for his background. You know, I've been in tech since the beginning days. My dad and I started an Apple and IBM dealership, computer retail store in 1981. So I've been doing PCs since the birth of the PC. Went to Apple. I was the worldwide introduction manager for the Apple IIc in 1983, 84.
Oh, wow.
Have some great Steve Jobs stories from back in the day. And then came back to Chicago because my wife said, if you want to stay married to me, I'm going to be in Chicago. And so that makes it really simple, family first. And by the way, this in a month is going to be our 40th wedding anniversary. So
wow,
I guess that worked out. Came back to Chicago and became a serial entrepreneur. I started my first company in 1986, took in venture capital in 87, when there was not a venture capital industry, when maybe there were 20 VCs in the entire country. But I was able to raise money, start a company, built the second product ever for Windows 1.0. I was really, really early, the first object-oriented programming language for a PC. Sold that company to Symantec. and then did a series of companies. I had my next company was an educational software company. The company after that, which failed miserably, by the way, because timing matters and we were a little bit early. And then had a game company that was started in August and we sold it in May. We were SoftBank's second acquisition in the United States. That's a great story. And then started Kettle Venture Partners in the .com days. And so I have, we had two funds. The first fund was during the .com growth, and that was a lot of fun. And we had a couple companies go public. And then the second fund we closed in January of 2000. That was not so much fun. I'm proud to say that 12 years later, we ended up being in the top quartile for our vintage year of venture funds, which means nothing. All that meant is that we were in the black and we got our LPs some money back. And then I had another company, a healthcare company, that was my biggest success. And then the weird thing, when I was 50 years old, I took a job. This is in 2008 with Redbox. And I was one of the earlier employees and became the head of innovation and the head of marketing and helped take them from, growth stage and getting it up and off the ground to a couple billion in revenue and 1/3 of all U.S. households renting from us. We went from 0 to 2 billion in revenue in 5 years. And
it's a fast ramp.
Loved that experience. I learned so much about how to grow and scale a company. And then when that ran its course, I ended up starting Math Venture Partners with my partner, Troy Henikoff. And we added our third partner, Dana Wright. And our we're early stage tech investors, and our investment thesis is really centered around companies who know how to sell, who have an unfair advantage in customer acquisition. We think that most companies and most entrepreneurs are really smart, but we have a saying, the greatest product in the world without customers is a great product, but it's not a business. And so that's the short version.
Cool. So, I want to talk about exits. And in a previous life, I was in the M&A world. And so, we've got a lot of curveballs for you guys today. But before we get there, Mark, on July 19th, you published an article titled The Future of Math, which revealed that you will not raise a Fund 3. This came as a surprise and honestly a bit of a shock to me and many others in the ecosystem here. Why the decision not to raise a new fund?
Well, first of all, we always put the interests and needs of our LPs first. The LPs are our limited partners, the people who give us money, as you know. And we are looking at the environment. Raising capital in these market conditions have been a little bit harder than we expected. And we got to about halfway through to our goal, and we just decided that it wasn't in the best interest of our LPs to do a smaller fund. It's not something that we wanted to sign up for. It still was a good-sized fund, but it wasn't what we had anticipated for our third fund, and we didn't think it made sense. The model made sense, and we always lead from a position of integrity and doing the right thing, and we felt that was the right thing to do for our LPs, and we felt that it was an honest assessment of the reality in the marketplace.
Mark, it seems like most firms that decide not to raise new funds tend to sort of fizzle out over time.
Yeah.
They don't do an announcement. Some years can go by before you figure out that a firm has decided not to raise a new fund. First of all, I applaud the fact that you guys, are, so to speak, exiting right and announcing, publicly what the plans are and the strategic direction for Math. Why the decision, though, to announce this instead of just, slow down and let things kind of run course?
Well, the question is, who do we serve? So we serve our LPs, and we also serve the entrepreneurs that we partner with over time. And there are firms, rightfully so, that you point out. I think of them like zombie firms. They're really not investing, but their shingle is still out there, and they're talking to entrepreneurs, and maybe they hope that a year from now or 2 years from now, the market conditions will be different. And I don't think they're being honest with the entrepreneurs or with themselves, and they're not being transparent. And we felt it wasn't in service to the entrepreneurial community to not be open, and we don't want to lead anybody on. And we always try to lead, once again, from a position of giving back and helping. And if we're not going to help, so let me be very clear. We have 50 portfolio companies that are active in math. Troy, Dana, and myself, the general partners of math, for the next 10 years plus, we are going to be sitting on boards. We are going to be actively managing the math portfolio. We are going to do everything in our power to make sure that math turns out to be a top quartile producing fund. And at the same time, while we may not be actively investing, we are always, if you know Troy and Dana and myself, like a day doesn't go by that we're not going to be helping entrepreneurs, coaching, mentoring, being a friend, giving them, the honest feedback that very few people will give. And now actually it's even a little bit easier because it takes off the pressure of, are they going to be an investor? And now we can just, as we always do. So we lead from a place of giving back and openness and transparency, and that's why we announced it. I would also say that we also wanted to send a message to the industry at large too, which is relationships matter over time, and we wanted to model behavior of what we felt was the right thing to do.
Well, many have described you as a class act. That may be the understatement of the year, but, appreciate all the transparency. And Mark, is this the last we've heard of Mark Ackler, the investor, or will we hear from you again?
No. Well, I am sure that Troy and Dana will continue to be investing in some way, shape, form, or another. I'm 64, and a venture fund is a 10-year commitment plus. I don't think I'm going to be a GP. Like, this might be my swan song in terms of being a GP. But that said, as an angel investor, or maybe as an advisor to other venture funds, if I can help in some way, shape, fashion, or form, I will.
Wonderful. Wonderful. Well, back to why we're here. So, back to the book and the topic at hand. I can tell by the title alone that this was written for founders, which is great because founders need a lot of help with this. And there's a lot of sort of potholes and challenges that they can run into along the way. First things first, does the book apply to both venture funded startups as well as those that have not secured venture financing?
Yeah, sure. So the answer is yes. And the question you didn't ask is, many people think that this book is written for founders when they're ready to sell their business. And it is. That's why we wrote the book. But it's the decisions you make at the beginning of your journey actually have an outsized impact at the end of the journey. And there's a lot of
such as what, Mark? Give us some thoughts on that.
Well, who you give equity to. Do you give equity to co-founders? Does the co-founders' equity vest? Like, do you have debt equity on the cap table? Do you give equity to advisors? When you raise money, we're very respectful. We know how difficult it is to raise money. But as you know well, not all VCs are created equal. There are some great VCs who add a ton of value, and there are some VCs who I would never want to be on a cap table with ever again, right?
Or a board, I'm sure.
Right. And so who you bring into your cap table makes a huge difference. And one of the things that we talk to entrepreneurs about is, at the end of the day, there's something, as you know well, there's a waterfall distribution of proceeds, which is it's just a simple way of a complicated way of saying something simply, which is who gets what. There's
and when, right?
And when, and of course, right? So there's X amount of money to share. There's different classes of shareholders. What do the different classes of shareholders receive, and when do they receive it? And the question I ask to entrepreneurs is, okay, when it's time at the very end, when there's a waterfall, what are the common shares worth? Mm-hmm. And so those decisions you make at the beginning, and there's a lot in the book about those early days too. So it's not just the wisdom that we collected at the end. It's also the wisdom that we collect that have an important impact at the beginning of the journey as well. And Mert, why don't you talk about how the book came to be? Because I think that's a really important part of that question.
Well, first of all, our starting point was, we sort of asked founders what they currently get advice on the exit. And it's sort of like, Folktales. One founder who sold a company tells it to the next generation
Right.
of like, oh, here's how it happened to me. It's sort of like this like passed down, whisper game. Everybody sort of like passes along these stories. But it was really missing a core component, which is that's a single perspective. That's sort of like the founder's view into how it all happens. So we thought that was incomplete because one, there's so many stakeholders, not just even the founder, your board, your team, your co-founders, like everybody from the sell side of, there's a lot of perspectives there, but also on the buy side. There's the whole team dedicated to buying companies. Well, there's a CEO, there's a CFO, there's the head of product. Like, there's so many competing priorities from the buy side as well. And we really wanted to get a 360 view of not just folks who are buying and selling, but also folks who are around us, the investment bankers, the M&A lawyers. And we wanted to get all their perspectives. The core of our question that we asked everybody was, what do you know now that you wish you knew 10 years ago? If you were giving advice to not just sort of a friendly founder, but to your own kid, imagine like, this is the real advice. Like, don't pull any punches. Give us the real nuggets of wisdom. And what emerged sort of is a sort of collection of stories that almost like shift perspectives. We're looking at the same thing, but it all looks different from different angles. Yeah. And so as a result of that, one of the really like wonderful, humbling things that happen as a result of this is we're starting to get, sort of like requests from folks that are from larger companies like Pinterest or Google, where they're essentially passing the book on to their heads of product and basically saying, hey, think about M&A with this sort of way of framing. Because you want to understand, this whole process, but not just from the big company side, but also from the smaller side, from the entrepreneur's perspective. So that's been really, really gratifying for us. Is that we didn't sort of just say, "Hey, founders, read this." We really wanted to create this like 360 view of how this whole thing emerges as sort of probably one of the largest decisions that a founder ever gets to make in their lifetime.
Well, it's hard to maximize the outcome if you don't understand all the stakeholders and their various motivations and incentives.
Yeah. And so the journey, you're absolutely right. And so we're huge believers in empathy. And the journey of this book was Mert was going through a transaction, and it was a difficult transaction. There were a lot of ups and downs. There's an emotional arc. Most transactions have that. Most transactions, it's not a smooth line. The vast majority of transactions, there are days where the transaction's hanging on the precipice. And while Math was not an investor in Mert's company, both Troy and I were his go-to mentors. I'd get the phone call to talk Mert off the ceiling. I was like, okay, got it. Like, here's what we do now. And when it was all over, when the transaction concluded, which, by the way, concluded in March of 2020, so right before COVID, Mert and I were having a coffee right before COVID shut everything down. And Mert is just bitching. Like, And what I said to Mert, first, dude, this is a joyous moment. Like, you just nailed it, right? This is great. We should be celebrating. And in the spirit of giving back, you should go into the relationship with your new company with a good, you owe it to them to have a healthy attitude and point of view and perspective, and let's clean the slate. And to give back, you should write it down while it's still fresh in your mind, everything that you went through, so that the next time they buy the next company, you can say, hey guys, this is what I went through. Here's how we can make it better. And out poured forth, page after page of notes. And I looked at that and I said, Mert, there are tons of books out there for entrepreneurs about how to raise money, how to start a company, culture, sales, marketing, HR, like every topic under the sun. Yeah. There's very few books out there about exits. And part of the reason is exits are confidential. We sign confidentiality agreements, and if it's a good exit, people don't want to brag. If it's a bad exit, they might be embarrassed. They don't want to talk about it.
Yeah.
And so it's kind of a taboo subject. And we realized, we need to shine a light and bring all this collected wisdom that was, Mert talked about folklore. So we interviewed dozens of CEOs, and we got great stories and some really good lessons learned. And we interviewed corp dev leaders at all the big tech companies, and we interviewed M&A attorneys and bankers. And this book was such a joy to write.
It's amazing. Mert, you're a brave soul, One never wants to violate the earnout with specifics, and I'm sure you've walked the line well. But, Mark talked a bit before about, you got to plan this from the beginning and think about, cap structure and advisors and all these different players that are a part of your business. If we move forward to seed stage, I see this happening often. But, many times strategics will get involved very early on in a startup's life. They may be customers, channel partners, or see the startup as maybe a threat or an opportunity. And if we, assume that this startup in this anecdote is at the seed stage, they've taken some funding, and now a potential acquirer is expressing interest in investing, they want to see under the hood, they want to do some deep diligence. What would your advice and what thoughts can you give for the founders out there to kind of navigate these situations?
Number one, I'm of the philosophy that if an early stage strategic is going to get involved early on, they should be a customer or a channel partner. They should help you sell more of your stuff. But the second you invite them on your cap table, all sorts of competing incentives start coming into play. So the first answer is, can we just actually start structure a relationship that just means more sales for us? We always want more sales. We always want more customers. How do we frame a relationship that allows us to deliver more impact for our customers? That's what I want to solve for first.
Got it.
But in the event that we want them as investors, or maybe they start digging in and they want to do more, I always want to have more than one. I'm a big believer in, if we are going to have a strategic, that better not be the only strategic that we're working with, because inherently we want to have some sort of competitive nature that allows us to sort of play these relationships off of each other. The playing field is not level. A giant company has way longer of a time horizon, has way more resources, and frankly, can afford to waste a whole lot more time than you can. And the reality is, as a startup, that is flattering. This large company, my gosh, they're interested. I'm so humbled. Everything in my life sucks. My customers aren't paying me. My payroll is through the roof. My runway is getting shorter. As a startup founder, life is tough. And here is this beacon of hope. Oh my goodness, they're interested.
Yes.
They like me. It's such a good feeling. I know, I felt that feeling myself. But always bring it back. Does this help further the mission? Does this help our customers? If it's not doing that, then there's a very good chance that this is just a good feeling and sort of a mental escape for you from your very real startup problems and nothing more. And this is something that I wish I could just, tattoo on every founder, because I know how real the feeling is. I know how amazing sort of that potential exit sort of just feels like when there are real problems to be resolved. But we have to sort of stay untempted and stay focused on the mission.
100%.
Yeah.
I had a seed stage founder, very early, get emailed by two CEOs of major multinationals directly from the CEO. And he was calling me, he's like, Nick, this
my God,
this is incredible. What should I do? But, it begs the question, is there any circumstance where an early stage startup should take funding from a potential acquirer?
Well, of course, but with caveats. So, for example, revenue is always better than equity, and distribution is way more important than equity. But if there is equity, one of the challenges also is a right of first refusal. So as a VC, Nick, one of the things that VCs are particularly sensitive to is when strategic investors have the inside track, have a legal written right of first refusal to purchase a company. For me as an investor, that's almost death's door. We won't invest because it will, by its very nature, limit the potential of the exit.
Right.
But before we talk about that, let's actually peel it back just for 1 second. We built a framework that we call FAIR, Fit, Alignment, Integration, and Rationale. And Mert, I'd love for you to sort of like go through that framework, because that framework is also really helpful in terms of how do you begin the process of building a relationship with a strategic. And one of the things that we talk a lot about in the book is trust. That trust is the lubrication that helps deals get through to conclusion. And when we talk to corp dev leaders from all the major tech companies, they all said exactly the same thing, which is we love to acquire companies where we already know them, have an existing relationship, and where there is trust. And so building that relationship is also an important, building trust is also an important part of that equation. So Mert, why don't you take us through FAIR?
Absolutely. Who you should sell your company to is perhaps sort of a limited way of like asking this question. It really is like, who's the right partner that is going to go the longest distance with you? So we want to take this as a case-by-case basis with, should we take funding from a strategic? Well, I can think of an example where it was a fantastic outcome. Flatiron Health got acquired by Roche. Nat and Zach are two founders that I really, really look up to. Roche was a strategic investor in Flatiron Health that led to the exit by Roche, and it was a $2 billion exit, and everybody was happy. But what made that relationship really special was, if you look back and sort of, again, peel back the onion, is that it hit some key components of like how this whole thing came together. So we wanted to provide this resource for founders that sort of allows them to put a lens on to ask themselves, is this the right partner? Is this the right long-term person for me to go to distance with? And we call this framework FAIR. It's 4 elements. F stands for fit, A stands for alignment, I stands for integration, and R stands for rationale. And if you happen to have all 4 of these elements, you just have also found the person who's willing to pay most for your business, the person who's going to create the most impact with your business long term, which then translates to a better price. So fit is cultural fit. Do we get along? Can I sit next to this person in a plane and, have a great time in the end of this? Do I admire their brand? Do I admire the way they treat their customers? Very, very hard to tell short term. Super easy to figure out long term if you're culturally aligned. Second, alignment. Are we aligned internally with our stakeholders where we want to go? But is the acquiring company aligned with where we want to go? Are we looking in the same direction? Not eye to eye, but in the same direction. 3, integration.
Wait. Hey, Mert, before you go to 3, I just have one editorial comment on alignment, particularly in this world that we live in today. When different classes of shareholders have different financial motivations, we get out of alignment. And what we're seeing in the past few years, Nick, where valuations weren't tethered to underlying economic reality, when terms were really founder friendly, we oftentimes would see deals where the founder came out great, but the investors did not meet their objectives. The same is about to happen in the reverse. We're starting to see much more onerous terms. Valuations are coming down. Terms, we're seeing participating preferred, 2x, 3x, 4x, multiples, preference stack, dividends that are much higher dividends. The whole point being is that, once again, when there's a waterfall distribution, if the different classes of shareholders have fundamentally different motivations, financial motivations, things are going to get out of whack. So alignment is really much more important than people realize. So sorry, Mert, I didn't mean to interrupt you.
Incentive alignment between founders and investors, but also between investors, I think is part of the message here. Yeah,
for sure.
Absolutely.
Yeah. Especially because I think what, Mark, you've just highlighted is that, in a bull market, certain terms are inherited. In a bear market, they could be different terms. And if those things are in conflict, creates all sorts of unintended consequences.
Yeah, I've lived through down markets. I've lived through the .com days in 2008, and I've seen, I'm a sort of a centrist. I like it when classes of shareholders are not 100% aligned, but aligned enough so that our interests are relatively the same. Mm-hmm. Our motivations are relatively the same. And I've seen, back in the day when the VCs, when money gets tight and the VCs want their pound of flesh and the terms get really onerous, And that's happening now.
Yeah.
The VCs think that, oh, this is great for me, I'm going to make more money. But the truth of the matter is that when you're really out of whack, when the alignments are out of whack, when the financial incentives, bad things happen.
Right.
So
Different.
anyway,
Maybe
so
different.
Mert, so fair,
Yes.
fit, alignment,
Back to fair.
back to fair.
Third element is integration, how these companies come together. And then finally, the rationale is, why are we in the room to begin with? What is the overall objective that we're working towards accomplishing that the two sides couldn't have accomplished on their own? So in a financing situation, from a strategic, I would want to ask, is this deal fair? Not fair is not, are they paying, the right amount, but is it fair? Like, do we have fit? Are we aligned? Is there a plan for these things to come together? Is there a rationale? If we ask these tough questions, and these are questions that don't make it into the term sheet, these are questions between parties. These are, hey, are we partnering on this journey together? And it's questions that founders unfortunately avoid or don't even know to ask to begin with, because it's so exciting to even get this kind of validation to begin with. But we always want to circle back into, the FAIR framework with an eye towards impact towards customers, with an eye towards impact, with an eye towards realizing something that we couldn't have done by ourselves. And as long as it's fair, we think it's fantastic. Now, obviously have more than one party, ensure that, you're protecting the rights of all your shareholders, that this doesn't limit your long-term prospects. Obviously, if you're singled down to a single buyer as a result of this relationship, it's negative. But ultimately, founders can find their way out as long as there's a true rationale that we're working towards.
And to that point, the rationale is sort of the Jedi mind trick, which is going back to empathy, understanding the larger acquiring company. What's important to them? What are their KPIs?
Right.
What are they measuring? How is the impact of your company, product, people? What is it going? How is 1 + 1 = 100? Right. And the more you understand that, and every time you have the opportunity to meet with a potential strategic over the course of years and time, it's an opportunity to both provide thought leadership, but it's also an opportunity for you to ask a lot of questions and to learn what strategic direction they're going to, and helping them together build a rationale. Mert, you like to use the example of checkout software. Why don't you give that as an example?
Well, if the oil company wants to buy your house, it ain't because of the countertops. Find the oil, we need to understand that. When a venture fund wants to invest in your startup, the rationale is very straightforward. We want to make more money later on. When a strategic wants to invest, there's oil. And it's not just we want to make more money down the road. We want to know the real strategic rationale. Let's think about a fictional example here. Let's say we have a software startup that improves checkout rates in abandoned shopping carts. It's a known problem in e-commerce. Everybody has some sort of a abandoned cart problem. If you improve this by 1%, that's valuable. You might get some SaaS revenue as a result of this. And let's say you have $1 million as a result of this. Congratulations. SaaS companies sell for 8-10 times forward-looking revenues. Congrats. Is this company really worth $8 to $10 million? What if Shopify was buying it? What's 1% checkout improvement rates for Shopify worth? What's that worth for Amazon? We have to sort of ask this, not just from what we have done in the past. Here's our revenue and a multiple on that. We have to build this rationale with what we can do with the acquiring company. If the acquiring company, if the oil company wants to buy your house, find where the oil is. This is where really, truly what this comes down to. In a strategic investment, it's exactly the same. We want to find out why. Why are you doing this? It's not just because I have a big mustache and nice glasses. There's rationale here that impacts your core KPIs, and I want to understand that reason why. If you do, then you're on the right track. If you don't, you're running blind.
So good. It's really hitting home for me. Back from my old days in M&A. Part of it is this discovery exercise.
Yeah.
For the company, right, to figure out the motivations of the potential acquirer, and then part of it is figuring out where are the gaps. Where do they need to go? And then you kind of paint this future reality of how your startup is the ideal sort of future reality. Hey, what would the difference be in a strategic acquisition versus a financial? Are there different ways that founders should think about financial buyers versus strategic buyers?
Well, to me, the first question is, what is the best home? We think of CEOs as servant leadership. And they serve their customers, they serve their employees, they serve their strategic partners. And how can we create the most value? Maximizing a number is one way, right? And there's multiple types of exits. You've mentioned two of them. But before we talk about that, let's actually wind it back just a little bit. We have this concept of an annual exit talk that most of the time in our industry, CEOs, it's kind of taboo. CEOs don't like to talk about exits because if they talk about exits to their investors and their board, maybe the perception is their heart's not in it anymore, they're giving up, and maybe it's time to replace the CEO. There's a threat. And because of that, CEOs are very reluctant to have the deeper strategic conversation. We think that's wrong. We completely disagree with that fundamentally. We think there should be an annual exit talk, maybe the first board meeting of the year. It's regularly scheduled where the CEO is completely free and it's anticipated that we're going to collectively as a board have the strategic, not the tactical, the strategic conversation of where are we? Are we still having aggressive year-over-year growth, or is sales starting to slow down? Is the technology still cutting edge, or is it starting to get a little bit older? Are we starting to see market share erode or competition coming up? Or, a great forcing question is, hey, there's still more growth, but VCs, we're going to need to do another round. Are you in? Right? Like, are you going to continue to fund us because you see that growth with us?
Sure.
And if we create an environment where there can have an open and transparent and strategic conversation, and by the way, it's not just the CEO. Nick, as you know well, VCs have life cycles. So if it's year one of a fund, it's great. Let's go put a foot down and grow. If it's year 10 or 12 of a VC fund's investment, well, hey, the clock's ticking and our LPs want to get their money back.
Yeah,
and
show me the money.
We might feel differently about when the exit should come.
Right.
And VCs, we don't talk to each other that often about, hey, where are you in your fund cycle? What do you need? And so by having this conversation on an annual basis, one, it gets rid of the stigma. Two, it does a better job of aligning all parties. And three, it gives you the luxury of time. And the luxury of time, if you know that, hey, 2 years from now is probably going to be the right time to sell, or a year and a half from now, what that does is you say, okay, who's the most likely buyer and why? Is the most likely buyer going to be a strategic buyer? And if it is, you probably know the 3 or 5 most likely candidates. And what do they care most about? So, for example, if they care most about top line growth, well, you could sort of spend a little bit more money on sales and marketing and really, focus on top line growth. If they care about your IP, it gives you can get your intellectual property house in order, your deal room in order and cleaned up, and you can make sure that all the employees have signed their IP assignments, that the trademarks have been filed correctly, that patents have been filed appropriately as appropriate. If you think it might be a financial buyer is a most likely buyer, and maybe they care a little bit more about EBITDA, well, then you can tighten the screws on EBITDA and maybe, cut spending a little bit, focus more on profitability if you think that that's going to be the most likely acquirer and what they're going to care most about. And so by having this annual exit talk, it is an aligning function. And by the way, when we talk to leaders of corp dev, we say, we ask the question, why do deals fall apart? They fall apart for lots of reasons. But one of the reasons they fall apart is a real sloppy data room where the financial information is incomplete, the intellectual property information is incomplete, the legal documents aren't filed appropriately, right? So it gives you the luxury of time. And it gives you also the luxury to build relationships. Mert, what would you add to that?
Well, I believe that even the financial acquisitions, like say it's a PE fund that's acquiring the company, the best ones are strategic in nature. It's part of a roll-up. Oh, we're putting these 5 companies together, and as a result of that, it's going to be more valuable. There's strategic rationale that goes into that, even if it's a financial buyer.
Yep.
And your company is going to be worth more because it's plugging that strategic hole in that roll-up environment. So the more strategic, the better it is. And I mean, when I say better, it just means that you're going to get a better outcome. You're going to maximize your return. And more importantly, you're also going to build your legacy, because the dream here isn't to just pass a hot potato on to the next buyer. The dream here is to build something that lasts. The dream here is to look back and say, 10 years ago, you were in the start.
I like talking about these different types of buyers, right? Like, I remember from a story, there was a potential acquirer that was really focused on innovation. There was another one that was really focused on margin. There was another one that was just all about volume and top line. And with this particular business, it could be a framing exercise and a positioning exercise, right? The business could be positioned as any of those 3 for any of those buyers, right? Which helped in that case, maximize exit potential. I wanted to ask you guys, when a business feels like they're ready to sell. So let's say you're doing the yearly reviews and you've gotten to that point for whatever reason, the business, could be positioned for sale. How does one, assuming they've built some trust and they've done some exploration, how does one create interest, scarcity, and sort of mobilize a group of prospective buyers all at once?
Yeah, scarcity and urgency. One of my favorite words is, how do you create a sense of urgency as well? That's a great question. Before we answer that question, there's one other point I want to make. We kind of glossed over integration. Integration is the ugly stepchild of merger, of M&A. It's always the thing that happens. Oh, yeah, we'll deal with it afterwards.
Yeah, I never did that part.
But integration is perhaps the most important piece of the puzzle, because if you don't have a solid integration plan before a transaction, there are real financial consequences. So, for example, many transactions, they have earnouts.
Yep.
Well, those earnouts are dependent on some kind of
performance
metrics, right?
Yeah.
Well, if you don't get the resources necessary to the salespeople or the programmers, or it's not integrated into the acquiring company, or whatever. If that integration plan, or there's no integration plan and the cultures don't work out correctly, there's no real good leadership, and you lose your team. Your team just quits.
Right.
It's like, I really want to hammer home the importance in this fair framework that don't forget integration.
Don't forget integration. Or create so much competition for your company that you don't have these performance elements tied to your earnout.
Right.
Correct.
So, all right. So Nick, you asked now I'll get back to your question. So you asked the question of, like, all right, how do you start a process? How do you create those relationships? And the first answer, hopefully, is the relation. Let's split it between strategic and financial. On the strategic side, hopefully, you already know the 3 to 5 most likely strategic acquirers, and hopefully you've started building those relationships ahead of time, and you've already started building trust, and you know what's important to them, and you can pick up the phone and say, hey, I just got this inbound. We weren't expecting it, but it's making us sort of pick up our head and take a look.
Okay.
Maybe we should have a conversation, because I've got to respond to this other inbound request, and it's making us think about it. So on the strategic side, hopefully you already know you already have a relationship with the most likely strategic buyers. On the financial side, most entrepreneurs don't really have good relationships in many cases with financial buyers. And that's where a banker can certainly add value. Maybe, Mert, you want to jump in on that?
Well, yeah. You don't build a network when you need it. Like ideally, you have been building up these relationships. And I want to make this very concrete for founders. when SwipeSense was getting acquired, we had two bids. Essentially, when all the dust settled, we went out there and did the road show, talked to a bunch of companies. But there were really like two serious companies that we were choosing between. One of them was one of our competitors that I met at a trade show and made a point of meeting once a year. For the past like 5 years. The other one was a public company that I DM'd the CEO of, again, like 6-7 years ago, because I admired the story of the founder, CEO of this public company. And I genuinely just wanted to get some advice from him. Just like, hey, love what you've built. You're an immigrant. I'm an immigrant. Healthcare. You care about patient safety. I care about patient safety. That's really how our relationship started. I never really thought, oh, they're going to buy my company one day. This was a real relationship that we cultivated. Now, sometimes founders will ask us, well, what am I supposed to share? Like, I'm not, I don't want to give away my like secret sauce with my startup, with my competitors. That's not what we're advocating at all. What we're basically saying is, rather than sharing your financials or your trade secrets, add value to the conversation. Be a curious expert in the room that folks admire and want to build a relationship in. Mark has these wonderful 3 rules of empathy. And number 1 is, it's not about you, it's about them. Number 2 is, do your homework. And number 3 is, bring a gift. You have to put the person that you're building a relationship with from a strategic standpoint in the forefront. It's not about you and your priorities. It's about how what can add value to what they're doing. And maybe there's an industry trend that you're an expert in that you want to have a conversation on. But what we want to encourage founders to do is, look, every 18 months, you're totally okay with raising for 3 to 6 months. You're investing real time as the CEO, and that's totally acceptable. And yet, we're not even spending 3 to 6 days in cultivating relationships that ultimately might become the permanent home for your business. Be the curious expert. Build that network over the years without giving away confidential information, but by real adding tangible value to both sides, by being a known entity. That's going to pay back in spades when the moment is right. And by the way, I have a very specific point of view on this. You're selling the company whenever you want to sell your company. It's about the founder. If the founder decides to sell, that's ultimately all that matters. The founder decides to sell, that's it. Obviously, there are factors that impact this decision. There's a local maximum. We have more resource needs. There's competition stiffening it up. We need to invest more in sales. Whatever that is, there's many factors that go into this decision. But when you made the call, you don't want to pick up the phone and let someone know for the first time, by the way, we're for sale. You want the call to go to someone that you've known for years, that already trust, that know that you're the real deal, that you are someone that can go the distance with you. That makes such a huge difference in the bidding process, because it's, and Nick, you've been part of these processes. It kind of feels very transactional from time to time. Like, oh, like we're going on a roadshow, we're selling our company, like all this, whatever.
Especially
it doesn't feel real.
Under the advisement of a banker, it can feel that
way.
Oh
my God. It just feels so dirty, and really, we don't believe that's the way to maximize value. The way you maximize value is by impact. The way you maximize value is by sort of looking at, hey, here's the vision that we can build together. And you only uncover that through time and trust. It's not something you can just sort of like shop around and go, oh boy, look at this thing that we discovered. That's just not realistic.
Yes. Just a quick point that Mark mentioned that I just wanted to reemphasize. It's always good in a transaction, whether it's a venture financing or an acquisition, when there's an external driver. Right? Yeah. When you as the founder don't have to say, hey, I really want to sell. When you can go to somebody and say, hey, we got inbound from this other party,
that's the best.
Want to have when it's externally motivated, it's just much more likely to drive some progress on that front. So, just quickly, are you guys pro banker, anti banker? Does,
the answer is yes.
Well,
depends on the banker, I guess. Huh?
Well, it depends on the banker, and it also depends on the circumstances and the size of the company. Mert, go ahead.
The general rule of thumb is that the bigger the deal, the more useful bankers are. So as the dollar figures go up, then they do add a ton of value. And if there's especially a competitive process that you sort of want to shield yourself as the founder, and where like, look, I want someone else to sort of be the representative in here. If there's multiple parties that are bidding, there are famous examples of bankers doing wonders. I mean, the WhatsApp acquisition happened because of a banker in Morgan Stanley who like wrote a memo and like purposely leaked it to basically say, oh, WhatsApp is so super valuable. And like literally 4 bids came out of nowhere, like Google, Facebook, like a bunch of companies bid as a result of this memo. And guess who represented WhatsApp in the memo is the banker who wrote the memo. Like there are real case studies of like bankers adding a tremendous amount of value. But if you're just using bankers as sort of like glorified, like admins, like, oh, put together my data room and like respond to some email, emails and do some outreach for me. That's an expensive proposition, especially if the dollars aren't there. If it's a smaller in the teens, if you will, in the 30, 50, $70 million range, then you're basically paying a huge tax on this exit by doing stuff that you really should have been doing all along. Like, why pay someone to build a data room for you where you really should have been maintaining it all along? That's where we have a strong point of view. And it's also very, very critical. A banker isn't just going to magically sell your business. Like, you need to have something worth buying. They're there to sort of like make sure the I's are dotted and the T's are crossed. But I don't believe that you can run a fundamentally unsound business without a rationale, without alignment, without integration. And a banker just comes out of nowhere and says, let me walk you to the road to riches. That's just dreaming. That's just not going to happen.
I mean, to that end, I've seen founders make the wrong decision on bankers that had the biggest promises.
Yeah.
But if they had done their research and their reference checks and their, how much expertise do you have in this segment and with these types of buyers, they probably would have gone a different direction. So be careful with the big promises as well.
Totally.
For sure. And by the way, everybody has a point of view and perspective. So when we talk to the leaders of Corp Dev and we ask them about how do they feel about bankers, every single one of them was, we hate bankers. They have no value.
You see that pro forma?
it all depends upon the point of view. But in speaking of point of views, from a VC point of view, there is one value that a banker does provide, which is we can go to all shareholders, including older shareholders, common shareholders, and we can say, we ran a process, a thorough process. We did, we solicited all the appropriate bids, and this was the best outcome. And we can point to the process as a way of limiting liability from the VC perspective of a common shareholder saying it was an inside deal, you didn't get a market rate.
Interesting. Okay.
And that doesn't happen a lot, but boy, it happens for sure.
Let's make sure we touch more on, this phase that includes the transaction. I'd love to hear your input both on the negotiation piece, but also the valuation piece, right? Often, for this podcast and this audience, we're talking about high growth technology companies, right? You're not anchoring price on EBITDA and EBITDA multiples. What forms the basis of much of this valuation negotiation, and what advice would you guys have for founders?
So the first piece of it is most transactions are based on a financial number. Either it's top line revenue or it's EBITDA. And looking at a financial number is looking backwards. That's what you did in the past. That's not what we could do in the future together. And by creating a rationale of how these two, why these two companies, what happens when you take our product and put it into your customer base or your sales team, and how does it impact, Mert used the example of checkout software. Let's just use something, retention. If your product improves the retention rate of the larger the acquiring company's customer, that value of the improved retention rate dwarfs whatever the financial number is that you did. And let me give you a concrete example. So we talked about my partner, Troy Hennekoff. So Troy had a little development dev shop back in the early 90s. And, a small company, not a lot of employees. They built some inventory management software for Hyatt that they own the IP for. And they were pitching, Mert, what's the company? The
Medline.
Medline. Thank you. They were pitching Medline to do some work for them. And the CEO of Medline, and they mentioned this inventory management software. And the CEO of Medline says to Troy, we want to buy you. And Troy goes, I'm not for sale. And he came up with a number, and Troy goes, that's very flattering, but no, thank you. And a couple of days later, he comes back with another number. Troy says, no, thank you. Finally, he comes back with a number like 5X, whatever his revenue was at the time. And Troy went, 5X for a dev shop? Okay. And he sold his company, and Troy thought he got the deal of the century. He thought, oh my God, these guys really overpaid. Why would they give me 5X for a dev shop? Well, what Troy didn't understand was he didn't ask the question of, well, why are you buying us? So it turns out they took this inventory management software that Troy created, they modified it for hospitals, and they went to all of their existing customers and they said, you currently have a 1-year contract with us. If you take that 1-year contract and you turn it into a 3-year contract, we will give you this inventory management software for free. In the first year, they generated an incremental $100 million in revenue from that inventory management software. Over the course of 5 years, easily 500 million plus of incremental revenue. Now, what's the multiple on Medline's revenue? So you got to believe this was worth billions of dollars of value to Medline that they gave Troy, 5X. They gave Troy this little,
That's what we call it, an accretive acquisition.
Right. And so understanding that rationale is really important. Mert, like the Instagram story.
Yeah, well, Facebook bought Instagram at the time for $1 billion, and people thought Mark Zuckerberg was finally losing it. I mean, the company had just gone public. It was like, oh, look, this is like young CEO overpaying for the startup. They stole it for $1 billion. In 2021, Instagram drove 50% of Facebook's ad revenue, over like $20 billion. They stole it. It was an amazing, amazing acquisition because they understood where the puck was going. They understood that folks were going to be in mobile more so than they were going to be on their desktops. That's truly sort of an example of why Instagram itself couldn't have done the $20 billion, in ad revenue, and Facebook alone couldn't have done it themselves either. But together they were able to create something magical. So our general advice for founders when they're sort of like thinking about, well, is this the right number? Is they always to go back and say like, well, how did we arrive at this number? If we arrived at the number based on your past valuation, what someone else is willing to pay for it, what, your multiple on your revenue, what have you. If it's based on internal numbers, it's likely underpaying it. If it's based on what the acquiring company is going to do with you, it's based on here's how this impacts our KPIs, here's impact allows us to get to our 5-year vision, whatever the acquiring company wants to do that you're enabling, then we have the clue on, this probably getting to the right number. That's why it's so unique, and that's why these are built on trust over years.
1 + 1 = 100, right?
Absolutely.
So we can get in this industry. Just to kind of round out this discussion, are there any specific terms maybe related to the earnout, when a founder is actually commencing the deal that could be hangups that, you would highlight?
Well, the earnout is really a measure of how well the integration plan is built with. If the goals are realistic, if the milestones are within your forecast of what you believe you can do, then earnouts are no problem. Go all day. But you also have to remember, as a founder, you lose a lot of leverage once you're on the other side. Once you actually make it to the acquiring company and you're there, guess who controls your budget? It's not you anymore. Your resources are now going to be stapled to whatever the person that's going to be ultimately approving this and what their objectives, what their KPIs are. So that's why we really, really emphasize if there are earnouts, if there are milestones that are in the future, regardless of how realistic they are, we always have to put a magnifying glass on the plan of integration and the resources we're going to have access to in order to enable those milestones and enable those future value. Because otherwise, you're just basically signing up for empty promises. What happens if the market downturns next year? What happens if the sales aren't where we need them to be for the parent company? I want to make sure that the dollars that are eligible for my earnout are something that I truly can have reach for. And that the secret there isn't sort of like shiny, here's extra $100 million or whatever it is. It's not about future promises. It's about realistic paths of getting there and what sort of like resources you're going to have access to, in the meanwhile. So it's not a blank answer, but it's really the core is the plan of integration.
And I would add that a really important piece of the puzzle is what goes in a term sheet and what goes in the final docs. And a lot of times larger companies will say, I'm going to write a 1-page term sheet. I'm going to write a 2-page term sheet. I'm going to make it really simple. And the only thing you should care about is the price. Like, okay, the price is X. Mm-hmm. And the entrepreneurs, especially inexperienced entrepreneurs, focus, oh, great, the price is X. I'm going to sign the term sheet and we'll negotiate everything else in the final docs. Well, who's writing the final docs? It turns out that it's always the acquiring company that writes the docs, and the attorneys for the acquiring company, when something is unsaid in a term sheet, they are always going to write the language that favors the acquiring company.
Of course.
And the minute you sign that term sheet, you don't lose all your leverage, but you lose like 80% of your leverage. And so there's elements in the term sheet that are usually silent that we strongly encourage entrepreneurs to pay attention to and actually take the time and negotiate a longer term sheet. And so, things like closing conditions. Do they have 30 days or can they take infinities? Oftentimes term sheets are silent on closing conditions, or what happens if the large company pulls out, or why could they pull out? Is there any penalty to that?
Interesting.
Right? There's the whole compensation.
Because if they do pull out, you lose all your leverage, even with the other prospective buyers.
Right. Of course. And so if there's a no shop, how long is that no shop? Right. And, setting standards. We talk about compensation. Well, just the price for the company is one part of it. Part of it is earnouts. There's lots of negotiations with earnouts between the VCs who don't really care about the earnouts. They want to get paid today, right? They want to get paid now. And the CEO compensation. So the compensation for the executive team. Things like employment agreements. Should the CEO have a separate attorney? We haven't even talked about attorneys. We're big believers in hiring the best M&A attorneys you possibly can. This is not a time to use your small business attorney who's been great for the past couple of years, or use your brother-in-law or your cousin. You
don't get the value attorney.
Right? And should the CEO have their own attorney separate from the attorney who's representing the company? And so there's lots of nuances here. And in fact, in our book, we devote an entire chapter to the term sheet, the terms in the term sheet, what you should be focusing on, where you should be negotiating hard and when you should be negotiating it.
Yeah. We're going through a very public example right now with Elon Musk and Twitter about, sort of what happens when promises aren't being kept. Since the offer was made, Twitter stock went down a lot. Tesla stock went down a lot. Those aren't conditions to walk away. They were very, very explicit in the documents of like what would constitute sort of a breach that allows Elon Musk to walk away. Now we're sort of seeing this unfold live, and the price tag of walking away is a cool $1 billion. And I don't think Twitter is going to walk away from that $1 billion. I think they're going to want their money because of all this debacle that has been caused in the event that the transaction doesn't happen, which, by the way, I'll eat my shoe if that deal closes. So it's a legal battle that's unfolding in front of our eyes. But this is sort of an extreme example. Most startup founders aren't going to have these kinds of like magical $1 billion walkout clauses. But you need to think about it in a similar way of, hey, I want to make sure that the buyer is held accountable for the promises that are making to me. I want to make sure that there's a plan in which we're going to realize value. And if those promises aren't being met, I want my earnout. I want to be paid. There needs to be consequences. That sets up a really healthy dynamic of leverage that sort of protects the founder for the longer term here. Because as we all know, this playing field is not level. The buyer has way more leverage than you do. And we need to sort of empower the founders as much as we can to sort of understand what they're walking into.
Yeah. And by the way, once again, the minute you sign a term sheet, you just lost the vast majority of your leverage.
So guys, what we miss here, what are your final thoughts, words of advice, whether it's with regard specifically to exits or otherwise, for the founders or investors out there?
the most important thing is we talked a lot about tactical stuff today. We talked about how to maximize value, what to think about in an integration plan. This is stuff to do. But there's a component of exits that is less about what you do and more about who you are. It's about your legacy. It's how you'll be remembered 10 years from now, 20 years from now. And that has very little to do with how much money you made when you walk out of the deal. And it has everything to do with how you treated other people, how you treated your buyer, how you treated your team, how you treated your customers. Your legacy is built with your actions. And there's a lot of moments in the exit where you have to step up, where you have to sort of have a spine, and you have to sort of protect the people that got you there. There's a lot of moments, for example, where the founder negotiating it, there might be a better outcome for them, but worse outcome for their investors. Better outcome for them, but half their team walks away. And we always, always, always want to remind founders that this is about your legacy. Most of us are crazy enough not to do this once. Like, we're not in this so we sell a company and then buy an island and fish for the rest of our lives. We're kind of crazy enough to kind of do this over and over and over again. So the key question we always want to ask our founders are, will people who worked for you in this team join your next startup? Will your investors who invested in the startup enthusiastically write the check for your next startup? Will your buyer buy your next company? These are difficult questions to answer, but they're best answered by sort of having a long-term point of view. This isn't a short-term transaction. This isn't a I win, you lose. This works best if everybody wins, if this is a win-win for both sides, if we've created a non-zero-sum game. And this is a product of empathy and trust and long-term thinking. It has very little to do with how you negotiate the reps and warranties clause in the term sheet. It's all about your values. It's all about working with people that you want to be in business with for the long term, and feeling less about, you're passing on something that, the hot potato to the next buyer, and much more focused on like how we build a lot of value together and sort of be in a happier place that we were before. It's about that long-term thinking. So while it's a life-changing event, and boy, I hope every founder gets an exit, and it's truly an amazing experience, not just as a financial outcome, but really what it does to your career in terms of your next startup and the startup that comes after. It's part of your overall story. It's also a moment to really, really, really be difficult about, what those core decisions are and how you want to be remembered. This is what we want founders to walk away with. This is what we mean by maximizing and building your legacy.
Mert, you're a poet. That was beautiful. I couldn't have said that better. The only thing I would add on top of that is, look, we wrote the book to give back. We wrote the book to help entrepreneurs, and it has given us such joy when we talk to entrepreneurs. We've gotten lots of phone calls from entrepreneurs who are going through transactions, and of course, we're always going to help. And we've made, the principles in the book we have case studies now where founders have made millions and millions of extra dollars when they follow the principles, the guiding principles in the book. And just a shout out to the audience is we're always here to help. If there's ever anything we could do, please reach out to me. I could be reached on LinkedIn, just Mark Ackler, ACHLER, and Mert. You can reach out to us on email, but we're here to help. We know that the journey of being an entrepreneur, I've been a CEO 4 times. Mert has multiple, we are serial entrepreneurs. We've been in your shoes. We really understand, and we're glad to help if we can.
Mark and Mert, is there a resource aside from Exit Right that you found really valuable that you'd recommend to listeners?
Basically, every word Brett Felt has ever wrote, you should read. In terms of a startup author, is what I really like.
One of the best.
It's just truly one of the best. And of course, the podcast that we're on right now, for the TFR.
Hey, all right. Thank you, sir.
And I would add yes to the podcast, but also one of my favorite books is from Tony Hsieh, rest in peace. He wrote a book called Delivering Happiness, and it's a very short, easy book, easy to read, and it's all about taking responsibility and owning owning the relationship with the customer, and how does that translate, and how do you build a culture that's accountable to the customer? I love that book. and I strongly encourage entrepreneurs to read it.
100% agree. One of the best. And then finally here, guys, you mentioned a bit about this before, but what's the best way for listeners to follow along with Math and, keep up with each of you?
We're very active on LinkedIn. Mark Ackler, MarkAchler, or myself, Mert Ishiri, Mertiseri. I'm also on Twitter at MHI, easy to find. And just DM us, just reach out directly. We'll be glad to talk to you.
All right. They are Mark Ackler and Mert Ishiri, the authors of Exit Right, How to Sell Your Startup, Maximize Your Return, and Build Your Legacy. Guys, this has been a real pleasure. It's nice that we can connect in town and now the rest of the country and world can hear about it. But thanks so much for the time today.
Of course. And Nick, thank you for all the good work you do. It's really appreciated.
Thanks, guys. Appreciate it.
All right, that'll wrap up today's interview. If you enjoyed the episode or a previous one, let the guest know about it. Share your thoughts on social or shoot them an email. Let them know what particularly resonated with you. I can't tell you how much I appreciate that some of the smartest folks in venture are willing to take the time and share their insights with us. If you feel the same, a compliment goes a long way. Okay, that's a wrap for today. Until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks so much for listening.